before the monthly unenjoyment, as I always call it. For decades now, we've called it the unenjoyment report. But the unemployment report is out tomorrow. Is that the sole catalyst of what's going on in this marketplace? And the answer is, well, uh, it's one of the chinks in the link, so to speak, of what connects the dots to making the world go around, and that's money and interest rates. And of course, the economic data is one of the factors we'll be looking at with the Federal Reserve's meeting in 2 weeks. We know that because we just had a beige book report. So I don't want to take any or much time right now to talk about me and my background. Many of you are already familiar with me, I believe. We've created a few indicators that are very popular. We've created some software algorithms and some really neat stuff that has helped us to develop some amazing consistency in the market. And I think it's what people like about me from the feedback I get is the consistency in the trades and the fact that the information and the style of my trading that I've been teaching for decades is very consistent amongst various time frames and also asset classes. And that's what we're going to do today. We're going to take a look at the various asset classes and also some of the things that many of you may not be familiar with. What we've been doing for quite some time is I've put out a weekly, we started off about a year and a half ago, or actually maybe 2 years now, doing a daily thought, a weekly thought, and then I posted it on a blog. But then I really wasn't fair to, and I did this for myself, selfishly, for my own outlook for the week. And we do this for our trading members now. So if you haven't gotten it, it's because we stopped sending it out to the general public, and it's only for trading room community members. However, there are times when some of our members are not in the trading room, and we want to follow up on a lot of different trades, and as well as many people are possibly aware of some of the things that I've done with Twitter. Now this I just did because I was fiddling around with some old computers and some new computers. And anyway, if you're a Thinkorswim user, it's been a while since we've seen the red logo. So I just thought it would be kind of cute and see if we got feedback on that. How many people should we bring back the red logo in a bear market and use the TD Ameritrade green logo in a bull market in the equities? Anyway, we'll get to that poll later. But also little things that I kind of noticed. This was a little cute one. We were seeing that the equity markets was coming off their highs, and we did some studies in the trading room today and talked about what we call as the trilogy setup, and we needed to see if the market was going to behave in a bullish manner. We wanted to see this market break out above the 1963 level. I'm not sure that's when the Beatles first came into New York. I can't remember. But anyway, 1963 was a point that the market did not get back above in the afternoon session. And it just seemed that perhaps in a joking way, the market was doing great, and Donald Trump had a news conference, and as soon as Trump started talking, the market started tanking. So I'm not sure if the market is actually handicapping a political change. That was meant to be humorous, everyone. So I hope you can find that humorous. But it was a coincidence. Going through some of these tweets, you can take a look on the dates, and that's the neat thing about Twitter, and I'll get to that, the trade in Twitter in just a minute. But Twitter, we've actually put out some really neat stuff as a heads up in this environment. The other day, we've been looking for an outperformance or a sector rotation in one sector that we have seen that has had a lot of upside in the recent days are some of the retail apparel stocks, Lands' End, Abercrombie & Fitch, American Eagle Outfitters, Chico's, which had earnings last week, and department store J.C. Penney, which seems to have been breaking out. We have exposure on the long side of this. A couple little things we put out about in times, and many of you are option traders, and there's all types of different ways of trading options in a high implied volatility market. And this is not an option class, but more about directional trading and taking a look at the markets and coming to help you understand how I come up with some of my trades and some of these tweets that we've put out in an extremely timely method. How did we get to putting these out? Just to go through a few more, which is very consistent in times. Green Mountain Coffee Roaster. We talked about green, and in the last few days, it's had a nice little pop. But one that we really caught last week, another little joke here about Microsoft Windows 98. You guys remember that one? But we were actually talking about, even as early as August 26th, some of the retail apparel sector. So we started to see, or at least identify, there was a change of tide or a little bit of money flow going into the retail apparel sector. Another before that was, I think you guys can read the sense of humor or the little bit of sarcasm between the lines, but we were talking about Marathon Oil. Even in our own trading room, took a position in this. It was trading at $14.38. I mean, it's like buying a case of beer or 4 gallons of milk here in Florida. So this was one of the, we started to see when oil was kind of, down there in the upper 30s and everyone said it was going to 20, we started to identify a change in the volume and also a change in the scans started to pick up intraday, some excellent buying opportunities, low risk, high probability stuff. This is probably one of the most creative focuses in my own opinion, by the way. Of course, you guys don't have to put up with this by reading it, but I found this to be kind of cool to find Jimi Hendrix with Keith Richards, and I kind of put my own little twist on the Chinese interest rate action the other week. So anyway, that's the story behind my Twitter. I try not to jam a whole bunch of information that's not pertinent, but every once in a while I'll throw a blast from the past like you see with the Thinkorswim. So in essence, what we look for in the market and some of the tools, many of you have come here before and you've seen me give my prognostication on several markets, points of interest, one of which we take a look at this page here, which gives us our top 6 stock indices. Now, ironically, currently we are in a sell mode in the Qs. We're in a kind of a daily buy mode without going anywhere in the diamonds. The NYSE is in a PPS buy mode. That's the arrow here. However, today the NASDAQ composite flipped into a daily sell signal. The Russell today fell apart at the end. This morning we did Trade Station Thursday, as I do Trade Station Thursday every Thursday, a little market analysis. What I was looking for was to see if the market could get above this swing high and get a little bit of volume behind it. And the volume tool that I use is the OBV with a little moving average component. In addition, I have this little way of analyzing the strength of participation by looking at the breadth of the Russell and looking at the advanced decline on the Russell itself on a comparative ratio basis. Unfortunately, the Russell, while it is in a daily sell mode before a 3-day holiday weekend, it's in a daily sell mode the day before the unemployment report, with a decline in the OBV making a new low on a daily basis. The AD lines are, net neutral and it did not really reflect a major change, mainly because the index didn't move. Why am I bringing the Russell up? Because the Russell is more geared to U.S.-based corporations, number one. Number two, we seem to get this in the next few weeks. Now, I can throw out a day trade on Twitter. I can talk about a trade that happened in the past. That probably doesn't really help many people because you will have a poor shot of taking advantage of a trade like that. But when we put out information and I come up with how my way of thinking and the indicators and the tools we use to see this type of success, first and foremost, is you probably have to have time to digest it and then enter an order. And that's the other half, execution risk. Many of us have probably experienced in this heightened increased volatility period, execution issues, connectivity issues, systems get bogged down, can't get orders in, have to chase markets. So that's why doing homework ahead of time, preparing for what levels you want to look at is very important. It's not about the buy and the sell signal. It's also about the condition, the key word, the condition of where those buy and those sell signals come in. Ironically, the way I trade in the market and the tools that I use really haven't changed. Many of you guys have probably seen some of my books that I've written over a decade ago. One that I wrote, and it came out in December of 2012, and I can't believe that book's going to be 3 years old. It's a green book, and it's called Mastering the Stock Market. It has a lot of the techniques and the tools for equities trading. And I think that what we've created and taking the whole myriad of stocks and understanding how the market's trading, one really needs to take a step back and understand what affects the various indexes. And that's why we've got this important, very important page created, because in the market isn't, unless you're just day trading E-mini S&Ps, and even if you are day trading E-mini S&Ps, understanding the relationship of these indicators are very, very important. This is, again, the S&P 500, and I'll share with you the Spiders ETF. One of the things that we can see on this page is the advances versus the decliners. Ironically, today, as the market was marginally, believe it or not, marginally higher, marginally, one of the things that we noted, like unchanged marginally, but we noted that today we had 402 stocks actually positive, 96 negative, and it created the advanced decline to pop a little bit. What I really wanted to see, truthfully, folks, to get any kind of strength in the market is if a market's going to demonstrate bullish tendencies from here, and my belief is that we still have some uncertainty surrounding the market. September is going to be I think, continuous rough and rocky road. What I was hoping to see actually is an upside move into this area here of the old green line, which is the support in the S&Ps near the 202 level. All right, I'd like to see the S&Ps get up in that level, and if they did, I wanted to see what the condition is up at that level, meaning did we see a breakout in the advanced decline? Did we see a follow through in support from the volume indicator? So coming ahead of a 3-day holiday weekend, I would say maybe today and the last couple of days would have been more who wants to be really net short the market in case China announces more intervention? Who wants to be short the market? What if out there? You can always put a short on at a higher level if you're bearish, or you can always put a short on at a lower level depending on your level of bearishness. But who wants to put it on in the middle of this trading range? As you can clearly see, today's action is pretty much in the middle of this little trading range here in the last few days, ahead of a very kind of an important report and a 3-day holiday weekend. So my thinking is simply this. I think the market's undergoing a little bit of, or a massive amount of rotation. And let's move to just a different page here to share that with you. When we take a look at some of the names here, the correction at hand didn't just start 3 weeks ago, okay? That's for starters. We look at the energy complex. I mean, folks, this is the XOP, and the XOP, its correction started approximately over a year ago, all right? So weighing in on the market was obviously the energy sector, XOP. How about the consumer retail ETF, the XRT? That actually did start a little bit earlier in late June, early July, and the retail sector has had more of a pronounced beginning of the correction. One that a lot of people are very familiar with because everyone was involved in biotech. I mean, this correction started obviously back in the beginning of July, and it was one that we were a little early on the biotech. Why do I bring those big sectors to your attention? Because quite frankly, when you look at the NASDAQ 100, obviously there's a lot of influence with biotech. Biogen, Celgene, Amgen, all the big boys, they're all in the NASDAQ 100. So when we look at the NASDAQ 100, it is not the technology ETF that it used to be. It was influenced by just the single price of Apple alone. It has been transformed to having more weighted effect with biotechnology. So it doesn't really have a lot of the energy components to it as well. So you take out energy, you add in IBB, and throw in a Costco, throw in a Starbucks, a Tractor Supply, throw in a couple other tech names like Akamai Technologies, and there's your Qs. So you got to understand what we've been going through in this market in the last couple of years has been not just a sector rotational grind, but it's been a global shift of finding the keyword they use, alpha, the best place to put your money. And it's been kind of a short-term trade. It's also been, as I'm going to show you real quickly, and I'm going to change this from a daily chart. Let's move this to a weekly chart real quick. This is the Dow Jones Industrial Average. Remember, we went from a nice little move to the upside to a sideways action to, the Dow really hasn't gone anywhere. And one of the interesting aspects about the Dow is it's a high dividend yielding blue chip representation index. There's only 30 stocks in there, but remember last year, every analyst, the Fed, this and that, the market's going to crash. Everyone's been waiting for the stock market crash for so long. They probably don't know how to trade it right now. When I look at the weekly Dow and I see this huge decline with that hammerish type formation on a weekly chart last week, the first thing I kind of ask myself is, what's the condition of the market? If I've got this huge decline, then let me change this trend line because that certainly we don't need and then I'm going to change and format this trend line, and I'm going to make it let's make it fuchsia, and let me change the thickness. I'm going to set that as a default, hit OK. There we go. So now what I wanted to share with you is real simple. When I look at that market and I go, wow, that was a small little sell-off, and it came on a move. And there it goes again. All right, and I see that volume was pretty significant. The third factor that I want to look at, cross your fingers, is what was the participation, the amount of stocks that went down? I mean, what was that level? Well, as you can see, the level of the breadth as identified, it's of course the advanced decline on 30 stocks. It's like how many stocks went down? Was it a heavy decline? And as you can see, while price went down, it didn't stay down very long. The volume sold off, but the participation rate wasn't tremendous. So that kind of shows or proves a point that it was maybe a few names that went down, but not the rest of the main majority of stocks in that segment. This time around, I'm looking at, again, it's Thursday, it's the beginning of September, okay? And I'm looking at a weekly chart, and while the advanced decline is going down, one of the interesting components is from a week-to-week basis is that the advanced decline is kind of upticking. Now, we won't get the full complete reading until when? Tomorrow's close. But another thing that I'm finding very interesting on this breakdown is the volume level does not mirror the type of selling pressure, so it's a very thin market condition. That is a little bit, if I wanted to be extremely bearish, that makes me cautious, okay? So that makes me cautious about being an extreme bear on very light volume sell-offs when the breadth analysis is starting to pick up and you're starting to see nibbles in the market. Now, this might seem confusing, but it's kind of been a confusing market. Many of you have seen my work before. I'm sharing the tools that I use. This is the advanced decline analysis. This is a weekly chart, mind you. We've got persons pivots on here with the PPS. Now, looking at the advanced decline on the New York Stock Exchange Composite Index, I guess I can change the format here, so bear with me 1 second. Let me go to color, and let me go to, there we go. All right, so the AD line is, the advanced decline is plotted on a week-to-week basis is in yellow. Now here, if we are looking for the market to move down, and this is the one index that most, or as far as information for breadth analysis, market participation rate, this is kind of an important tool. But one thing that I've taught many traders is man doesn't live on just bread alone. Traders don't live on one index alone. Uh, we have a significant, a very significant change in the landscape in the markets that we trade and the indexes. First and foremost, the New York Stock Exchange Composite Index is no longer 100% U.S.-based companies. There are foreign companies in there. In fact, only 68%. 68% of the companies are only U.S.-based in the NYSE. In fact, more than half of the stocks contained in the NYSE are interest rate sensitive stocks. So bond funds, real estate investment trusts, things of that nature can alter the landscape of the breadth analysis here. So what I'm warning you is that we might get some false setups here. If we see gold going down, if we see the metals, if we see energy, if we see healthcare, these are more of the sectors that we're going to find that have a proportionate ratio change with the S&P 500. So therefore, doesn't it behoove us to look at perhaps the S&P 500, not only market internals, but also volume levels? And the answer, I believe, is hell yeah. So with that said, here is the overall trend of the market, the OBV or volume trend of the market. We had a huge sell-off in the market, and this is again a weekly chart. 1 week does not make a market crash, and 1 week does not make the market recovery typically. And what is kind of unique about this market is that, as you can clearly see, unless these indicators are inaccurate, and they're not, then the sell-off has been on light volume, and we need to get through the next couple weeks. And I think that's what, if you think about the next couple weeks, what does that represent? In 2 weeks, we're going to be sitting here with a Fed meeting, whether they're going to raise rates or not. Now, we have a recovery in oil prices a little bit to a degree. We have a change, a tide of change in various markets and segments that people are looking at. And how do we know that? Well, in the tools that I use, obviously, I'm sure a lot of people look at the various sectors, such as the top 10. Most people will look at the top 10, which are materials, energy, financial, industrial, technology, consumer staples, utilities, healthcare, consumer discretionary, and then maybe they look at transportation, which is in the, what you can stare at or follow is the IYT, transportation. All right. But we have a lot of subsectors that are moving things around, such as biotech specifically, the IBB, regional banks, the KRE. I find it interesting that one of the things that we wrote about this week, which let me just point out to you guys, in that document tab, this is kind of, now that it's the end of the week, we do this every week for our users. One of the things that we point out, let's just open it with, or at least you can go capture this week's tools. And in fact, in that document tab, if you want it, you know, you guys are visitors, you can all kind of snag the kind of analysis that we've been putting out for our trading room. This kind of spells it out what we did last week. I think we really kind of had some a lot of I would say some home runs and a lot of base hits with different things. Microsoft, Devon Energy, Marathon Oil. Anyway, looking at the VIX, things of that nature, kind of like everywhere. But here's what I wanted to share with you. For this coming week, this was written, by the way, you can see that this was, we put this out Sunday afternoon, by the way, so it's not like cheating after getting a heads up to the market, right? Um, Looking at my scans and the tools that we use, a few of the things that I wanted to point out to you is that um, of the 22 sectors that I've tracked, only 5 were still positive on the year. Now, biotech is, even though it's come off its highs, it's still positive. Healthcare, as measured by XLV, was positive. Home builders, ITV still positive. Insurers, the KIE positive. Consumer discretionary positive. And ironically, regional banks, the KRE, popped back up in positive territory a week ago Friday. Now, here's an interesting concept. What surprised me last week was that this Commitment of Traders report, if you're not familiar with that report, it's also something that is very important that we include in the TradeStation package, shows that the small speculators were still bullish because they were significantly committed to the long side, both looking at the futures and the options. So with that said, I'm kind of still, my concept was I was looking for a midweek. I was hoping to see an early week rally, midweek peak. And I think that the NASDAQ 100, since biotech and computer technology tend to remain seasonally weak through the end of September. And that's why September scares people. That's why September has a bad reputation. There are multiple sectors that are entering a seasonally weak period of time. So the question begs, did the market overextend and overemphasize the selling? If so, then some of the weak sectors may not go down much further, but they probably won't rally because they have that seasonality headwinds against them. I'm going to scroll down here and go into a couple areas that I was looking at, and I still am, and we did. And I think a few names will pop up as we have on our watch list here. If you're a stock trader, this is kind of important. If you want high risk, um, you know, big momentum trading, then this probably isn't for you. If you're looking for high probability, low risk, and potentially high profitability, then this might have an interest for you. And what we were looking at, what I saw with the indicators was a couple things. The motion picture and entertainment sector was extremely oversold. It enters a seasonally strong period in mid-September. Viacom, DreamWorks, Rent, these are some of the names on our watch list. Remember, I wrote this Sunday. Toomey is the suitcase people. You know, that's kind of a specialty, but looking at Guess Jeans, Abercrombie and Fitch, and of course Land's End, we had some others out there. And again, for the week, we gave our support and resistance targets. All of that information on paper comes out of what you're staring at here. And this is what I look at for the markets to help me make a decision in the market. I want to know real quickly, what's the long-term trend of the market? Is it up or down? And utilizing a radar screen such as TradeStation helps me identify, well, the long-term trend in XOP, this is where it says monthly pivot right here. It says that it is bearish. So let's look at a monthly chart. Well, yeah, I guess that's a good, that's a pretty good indication that it's bearish. So when I look at the longer term trend, it's like, yeah, that is bearish. There is no doubt about it. And when I start to see the technical tools, obviously something's going to change, right? Something is going to eventually change in the market. The short term has to start bottoming out, right? And I'm going to add, let me insert something here, insert technical analysis technique real quick, or slow, whichever way it wants to do it. And where'd she go? She's somewhere here. Let's show me, let's get into indicator. Looking for it. There it is. By the way, that's that commitment of traders report. I'm going to show you that in just a second. I look at this and I go, wow, you know, we have a format symbol. This is a, I just want candlestick. I don't like the candlestick with trend. Any event, here's a story. So many of you can see this doji, and why do you know it's a doji? Because it is painted blue right there. So you can see that candle's blue, and you can see this candle's orange. One of the neat things is the this, it signifies that this sector formed a daily high close doji. Now that wouldn't normally catch my attention, but with the criteria after a long downtrend, you start finding dojis at the green level, which is person's pivot support, and then you get a conditional change with an uptick in volume. That does get my attention, right? And so when you start seeing high close dojis here in the XOP, more importantly, as we go down and review sector analysis, guys and girls, you break this down by the right stocks, you can see the net changes in the market, but more importantly, looking at the key reversals. Did we get a buy or a sell signal? These little flashes are warnings that we generated a buy and a sell signal. And ironically, you can see in the energy sector over the last few days, in the last week, notice that a lot of the stocks in the energy sector flash, it's all green, right? That's not green because it's positive. That's green because they've been in a daily PPS buy signal. So that's what that signifies. And so we look for a day like today. Did we negate a buy signal by flashing a PPS sell signal? And the answer is no. What do some of these names look like? This is Devon. This is one we kind of picked on last week. Devon today, you know, very much resembles the XOP. Well, ironically, it's in the XOP. Sometimes you'll get the individual stocks that actually mirror the the ETF or the sector that they're in. It's very almost ominous that the market, I wouldn't say is rigged, but it certainly gives the impression that when we're looking at a stock and it has a very similar pattern to the over, how much influence it has to that ETF. So it's like, which came first, the chicken or the egg? When we're doing top-down analysis, we look at obviously what's the direction of the overall stock market. Top-down analysis is no longer simple like it used to be. I think I've already fully explained why, because of the sector weightings that each individual stock market or index has on it. The Dow versus the Russell versus the Qs versus the S&P 500. So what we really want to focus in on as well is some of these sectors, right? Remember earlier this year, how many people were hell-bent about Bank America, and Bank America was looking just, you know, rosy as could be. And Bank America stopped looking so rosy. In fact, as Bank America was starting to get everyone interested in how great it was, the volume started to fall off. Bank America's not on TV as much anymore as it once was, right? So what is interesting is that some of the regional banks, they're starting to look back into positive territory. This is First Republic Bank. By the way, they formed a daily high close doji today. It's just a case in point. Just when you think that the stock market was negative and everything was bad, not all is bad in love and war, and not all stocks go down in a bear market, which I think that's kind of important, that we need to be able to run scans and say, gee, how many stocks generated a daily high close doji? Actually, if that's a good question, we have an answer. First off, if you don't know what the high close doji is, then you probably don't know how to ask that question, or if that's an important question. This is that company that I was talking about earlier in the retail apparel sector. This is Land's End, by the way. And I'm sure many of you can add the math real quick. This is about a 20% move in about a short period of time. That's right, I said 20% move. One of the neat things about Land's End, LE, is the symbol, is it did generate a daily high close doji here. And so while the stock market today is down and you hear a lot of, it wasn't holding its rally, this is a name that it may have been a little over accelerated over the last few days, but boy, it sure gives you an argument that looking at some of the other sectors versus some of the retail apparel stocks, that money has obviously gone into some of these other names, right? And so when I tell you it's important to look at, and we have the high close doji scan, by the way, today 43 names, and I'll show you the format. The symbol universe right here is the S&P 500. And using TradeStation or any product, we could run a scan for any sector or subsector we want. The neat thing is what we want to do is take a look to see a couple things. This is very important, so listen to this. If I run a scan and I have with the criteria of the high close doji, what I want to see is where there are a lot of names in that specific sector that started to generate daily high close dojis. Funny thing is, Aflac and Insure, AXP is American Express, Bank BK is Bank of New York Mellon. I didn't cheat and see this beforehand. I ran this right before we started. I have not seen this. This is the first time I ran this, obviously, at 4:13 this afternoon. I have not seen this. So I'm looking at today's performance with you guys, just as you are. I do know this company name, Ralph Lauren. It did generate a daily high close doji, and I'm sure many of you are familiar with the fact that it's a retail apparel stock. So the point that I like to make is I like to see, are there high close dojis within a numerous amount of stocks within a sector? That kind of gives me a little bit warm and fuzzy feeling that perhaps maybe that sector's a watch list, or those stocks I can take a position in. If not the stocks themselves, perhaps the ETF or the sector that they're in. If you know anything about my work in the high close doji, that was a system. It's literally a system. It tells us when to get in, where to place our stop if we're wrong, and there are execution techniques to get out, which are very vital. And this is kind of a really neat thing as far as scans. By the way, I did want to be forthright, and let's just run, just because that's what today's presentation is about, is to take a look at the market together, showing you the tools I use. And, how am I coming up with these trades that I'm putting out there? Because it certainly isn't by throwing darts on the board. Today, by the way, and let's look at the format and make sure everything's correct. Yep, it's checked, S&P 500. We had no low close doji, no bearish low close doji patterns today, just 44 daily high close doji patterns for tomorrow. And it seems that there was a significant buildup in the high close doji formations in both some of the retail apparel as well as the financials. So, that might mean something. And if it wasn't the fact that I already know that tomorrow's the unemployment report, I would say, gee, maybe there's something coming up that's going to create this, market to see acceleration to the upside. Now it's a matter of how do we trade this thing, right? Today, by the way, we got 28 actual sell signals. We only got 10 new buy signals. The 10 new buy signals, WM Waste Management, it did form, as you can see, a buy signal with the arrow. It's a PPS buy signal. It also had a high close doji. It should be in, if I'm not mistaken. There it is. It's already tagged in the high close doji scan feature here. So looking at the market, if you're interested in eBay, again, I think that's a kind of a after the spinoff of PayPal, I find that kind of interesting to find that this stock generated a daily high close doji, and it's back to the levels before the August 24th sell-off of the market. These are kind of things that I look at. And by the way, I know there's a lot of people out there it's that are saying that, while this market could go down and we could get real ugly, and there is that possibility. Before I move on, and I don't want to go all over the map, I'm just showing you some of the tools and the techniques that I've used to help me navigate these waters and select certain segments of the market to be in it. There's the old phrase, the harder I work, the luckier I get. I don't know. I think my trading community make me work every day, so it's thanks to them for our successes. But literally, this is the monthly chart in the S&Ps. And while, we are in a PPS sell signal, and yes, the volume was a concern, the month just started, for gosh sakes. So if I had the insights to say, gee, I wish I knew where the market could be at the end of the month, the only thing I can do is try to handicap what are the best sectors to be in. And if I wanted to look at this chart in the S&P on a monthly basis, the first thing I would tell you is, man, we're in like almost no man's land. What do I mean by that? The monthly chart shows me kind of no man's land. Here's what I mean by that. The current price is 195. I've got moving averages up here between the 201 and 206. Let's just round up and say, the 204 handle for the midpoint, which is all these lows. So the question begs, can the market go straight down to hell in a handbasket, or are we going to go up and test the point of breakdown first and then see what buyers do when the market gets there? My own feeling is simply that I think the market is going to try to test the highs first. Not the highs, but I think we can go back and test those moving averages and then see what the market does there. That's what I think the market's capable of doing personally. What's going to get us there? Again, it was interesting to see student body left get bearish oil, and in 3 days, everyone rushed back into energies. I look at the dollar, and I look at the foreign currencies, and then I look at gold, by the way, and I look at what happened to the fear factor of people rushing into buying gold, and I don't see that. So as far as the S&Ps, I think what sectors are going to help give a increase, a rise in the S&Ps? That's what I have to start to assimilate. I have to start thinking, if the market is going to get back up there, what's going to take the market there, right? So let's take a look at what comprises the financials. And the first area of interest we want to look at, of course, would be insurance companies, right? Because the insurers are the KIE ETF. They're a component of the overall ETF known as the XLF. Many of you are probably familiar with the XLF. That's the financial ETF. But the financial ETF is not a pure bank play. It's a diversified ETF. But it has a lot of weight on the S&P 500. So what's in it? Well, there's a few regional banks, and that's contained by the KRE. And we could take a look at those two and look at these ETFs and say, gee, they look very similar in pattern. The big spike down, a muted rally, and it looks very similar. Everything looks kind of similar. I'm not getting any read. Big spike down, the market rallies, failed little rally here, a couple daily dojis. I don't get a whole lot of intel there. When I start taking a look at maybe top down and look at some of the insurers themselves, Metropolitan, MET, which is in the XLF, Prudential, Chubb maybe, because not all insurers are created equal. And then there's, again, Allstate, right? So different stocks have exposure that not all are created equal. Some are property casualty, Some, of course, Allstate had some horrific numbers with, of course, payouts and auto claims, as did Geico. So maybe that's not really what we should be looking at. Fifth Third Bank, maybe. FITB. Boy, that looks pretty familiar. PNC. If you take a look at some of PNC's charts, it's like, man, they are locked. Do you see what I'm looking at? Everything's kind of lockstep. I'm not getting a real clue that the strength is going to be coming from the financials. So where would the strength be coming from? We've already taken a look at the XOP, the energy sector, and one of the funny things that I see about the energy sector, by the way, is this anomaly. And this is one thing that we teach our traders, the difference between using volume histogram and this volume tool. That's a key element in the market. Funny thing is that if you look at this yellow line, would you say that the yellow line is back to prices that are maybe, let's see, back over here to up at this price level? Sure, right? So if I lied to you and said that yellow line was price and not a volume indicator, then you'd probably say, gee, we started to see a formation of maybe an inverted head and shoulders or a little bottoming pattern. We now have a small little, kind of very tiny, but you can see zigzag. In fact, we now have higher lows and higher highs. It shows a little bit of accumulation. So to me, this is just the XOP. What about the OIH? The oil service sector, not as strong. So the energy producers, providers, exploration sector looks a little stronger. And maybe that's the sector, because energy has weighed on the S&Ps so long. What would happen if we started to see energy stocks come back to life, right? That's one of the areas that I would have to say. And by the way, I know that we're coming up to a 3-day weekend. Some are going to make it a 4-day weekend. There's a lot of traveling going on. You know, the whole thing about the oil, I was just in Chicago this past weekend, last 4 days, and we just got back last night. I rented a car at Enterprise, by the way. Great facility. Every flight was full. O'Hare Airport was jamming. Of course, I don't know when it doesn't jam. Traffic is going on. Chicago was beautiful, kind of drizzly, grayish weather for the weekend. Lots of road construction. Thank God for Lou Malnati's pizza and dry ice, because I brought some of that home with me. But I'm here to tell you, I didn't see a lot of Teslas driving around. I know that when I checked into the airport, they asked me if I had electronic cigarettes on me. I didn't. And the point that I'm trying to make is that airlines and the world is still going by gasoline and diesel and jet fuel. So these refiners are there's still demand. So the question begs, if we're going to start to see a slowdown, an economic slowdown, and if the stock market's saying, well, it's not today, it might be in the next 6 months, then we might start to monitor the demand for the energy to be watching in this sector, XOP. That's the connect the dot. Start following XOP and some of the stocks in that segment. And I think that might give us a little bit of fanfare. Now, do you guys remember I talked about the transportation, the IYT? You know, it's like this. It fell first, and everyone was concerned about the stock market, but the delayed reaction, there was a delayed reaction. So now we have the, if you drew up a little technical tool, you can see here, and I'll just share with you format analysis techniques, and you can see that we've got the John Person quarterly pivot up. That's a monthly chart, quarterly pivot. I'm going to change the time frame real quick to a weekly chart. Let's look at this transportation sector. So while the transportation sector went down, the IYT, right? Now, you would probably agree with me that we're sitting here at roughly the same prices that we were back last October, right? I mean, this is the general area of October's close. And when we made that breakdown in 1, 2, 3, 4, 5 or so, this little short-term correction, the volume certainly, the OBV indicator came down significantly, right? Because everyone, you can kind of see that. So for me, it's like I look at this and I go, okay, the market's broken down, huge hammer here. It looks like a spike low. Crude oils, the energy stocks are doing well. What about the transportation sector? It led the market first, and perhaps we need to be following the transportation sector over the next couple weeks. We might get a little short-term bounce out of here, and so I'm looking at a couple sectors that some people might not think make sense. Usually oil goes down, transportation stocks go up, but if you overlay IYT to, let's say, XOP, they all went down together, right? In this little trend from this point in time over the summer, the XOP went down relative, and so did IYT. So, boy, that's kind of, against the grain in rational investment thinking. So is it that there's a lack of demand? Perhaps that could have been it, or perhaps the amount of people trading weren't interested in that sector, and that all the people are now conditioned not to focus in on that anymore. So I want to be focusing on these two sectors, and they might have an impact on the short term or the very near term in the S&P 500. This is American Airlines. This is a weekly stock. As you can see, the big market crash that occurred, if we look at the S&P, once again, SPY, take a look at this, we got all the way back down to last October's lows. American Airlines should have gone at least to October's lows. It didn't. Delta? Did Delta, maybe Delta, maybe they smacked the Dickens. No, Delta didn't. In fact, why is this indicator pointing up right now? Why is that point? Anyone wondering why that indicator's pointing up like that? I don't mean to be facetious and condescending, but boy, if it came out that way, I apologize. On a serious note, man, that does not show a massive liquidation in the airline sector. So I think that we need to pay attention to these and look forward into the market, do our own homework rather than listen to the news and follow them. Because if you followed them, let's face it, guys and girls, you've been short crude oil and gotten this one stuck in the keister. I have no other, that's about as polite as I can say in trading terms. This was a very dynamic move to the upside. So while the world was telling you to get short and it's even going lower, we saw opportunity based on the tools that we're using to get into some of these names. And I hope tonight I just shared with you some real important ways that we could start to think and get you to be a forward thinker. And I think that's a little bit about what, again, I think people like about me. And as I mentioned, it is the consistency in the trades and the time frames in which we use. I wanted to share with you today's little tweet about the ES when I said we need to get this market in the E-mini S&Ps at kind of like my trilogy trade, I call it, and I wanted to see the market get back above the 63 handle. At the time, what we were looking for, even though we got a little piece of a buy signal, 63 was a big number for us that I put up in the trading room before my time expired. It was this, what we call a last conditional change candle right up in here, and even the last, a new one had formed. So we could have actually brought it down to this one here. The market still, which is now 1957, many of you know that's the year I was joking in the trading room, looking at these trading levels. 1957 was the year my dad graduated from West Point, 1963, but quite frankly, what we were looking for it was a breakout. If we were going to go long this market, it needed to get back above that 63 handle. And so that's why I sent that, by the way. That's what, just in case you were, you'd see this and you go, what the hell is he talking about? So, by the way, day traders, watch a bullish strategy set up on a breakout above 63. So that was what that was all about and why that came about. Ironically, you can clearly see these gray lines. This is the last conditional change indicator that is on this TradeStation package. And the last conditional change is something that I've been teaching for, I don't know, I wrote it about in my first, it was in the first book, it's in the second book, it's in the third book, the green book for traders. So I definitely want to say we've had some really, I would have good, really good opportunities in the market. I hope you guys have learned from today what the kind of thinking that goes into the market, what the tools we're using, and just to give you guys a little bit of background, if you're looking to get started and wanted to learn a little bit more about me and want to get started with learning some of this stuff, the first thing I would tell you to do is go to Amazon, buy my green book. It's called Mastering the Stock Market. That's the first thing I would tell you to start with. If you're looking to learn a little bit more, then go to our website. It's a dynamic website. Many of you have been around there before. It's well, I'll share it with you. It's right here. It's personsplanet.com. There's a lot of phenomenal information. I mean, just fantastic information there. Besides, every once in a while, we throw out toss some really awesome, I would have to say, decent bones, especially in this marketplace, to give traders a heads up of what's going on in the world during the various tweets. We've been fairly active. One was another trade was CRE, by the way. So even whether you're bullish, bearish, looking at getting into Tesla puts before the big sell-off. This was we're sitting with those Tesla puts till Monday. Oh my God, that lower opening, that was a gift. That was unbelievable. So we definitely have had some stuff out there to keep our clients informed, and you, if you're interested in Twitter, which, by the way, Twitter is a trade real quick, just not to go off subject, but let's take a look at Twitter, because Twitter is one of those markets that longer term, it's starting to build that little zigzag of volume here that I don't know if it's going to get a lot of respect from immediate, because so many people are fed up with it. Kind of like when Facebook was at 16, 17 range, everyone thought it was even going to go lower. But the funny thing from a fundamental viewpoint on Twitter is I just saw this commercial for Domino's Pizza, and that stock symbol is DPZ, saying that I could tweet an order in. So they're saying that here they're promoting Twitter. The Justice Department used the Twitter to tell everyone they were going to go after LifeLock, which that symbol was LOCK. Watch this. This is the Justice Department sending out a tweet. The Justice Department tweeted, used Twitter to send out that they're investigating LifeLock, and that's that one-day debacle in that equity. So I mean, it is that there is eventually going to be a turnaround. What hour of what day of what week? Now, this is Domino Pizza. Actually, it looks like the same thing as the financials, right? But looking at Twitter, it is one of those stocks that over the last, let's take a look here together. I mean, it has gotten taken to the woodshed and some. And I know everyone's like wondering when they're going to make money, and I get that. And in a high implied volatility market, selling put premium, is something trained to thinking. I tweeted out a better strategy is to take a wider stance, a 30-40, the March. So you go out in time, you reduce some of that excess implied volatility. And, in the next 60, 70, 80 days or so, if the stock is just still right where it is, you'll see an implied volatility crush that's not going to cost you much money. So if you wanted to play Twitter, I would go with the March 30-40 wide. Is it an impossible task asking for the market to maybe just revisit, where it just was in July? Is that really an impossible task? That's where the stock was trading unless it files bankruptcy? I can't visualize that. But I think you'll find that those marks going out that far, it takes a little edge off of the implied volatility. After all, I'm looking at this trade here and looking at the tools that we have, and I'm trying to get this into focus again. One of the techniques, you could probably see this yellow line, this indicator here, right? This little indicator right here. It's starting to point up, and the prices started to point down. So many of you would say, well, at the technical school that I went to, they would have called that whatever this indicator is. If it's making a higher low and price made a lower low, it's flashing a little bit of bullish convergence. I have another little tool, the person histogram, and that also is confirming a little bit of price convergence. Only thing we're missing is a PPS weekly buy signal. We got to clear this last conditional change. Last conditional change on a weekly basis, and I'll share it with you right now, is 29.34. You can see it right over here. That if we get a close over 29.34, odds favor the fact you fire off a PPS buy signal, and I think Twitter's on its rise. So regardless of what tomorrow's unemployment report is, regardless of the 3-day holiday weekend, I don't think Twitter has a lot of Chinese stock market or Federal Reserve. It's its own product, and I think you may want to take a focus in on this. If you're looking to get started and want to learn a little bit more about how I view markets, like I said, you can go to Amazon if you're new to me and new to looking at my stuff, and go get the green book. It's called Mastering the Stock Market. If you're a seasoned trader, we have a premier trading service, and it's our mentoring. And what I'd like you to do, if you would, is go visit our website here. All right, go visit our website. And we have this survey here for mentoring. If you see it, really, it says here private mentoring. What I'd like you to do, if you want to learn more about sitting next to me and learning about as a seasoned trader, just click on that link and just take this survey. It's fairly anonymous, right? I mean, you could let us know if you want what your information. You're already in the contact list, so it's not a big deal, right? So if you got an email invitation to attend today, then just fill this out. It's something we were interested in finding out about people, where they're at in their training and their trading. And if you're interested in our mentoring services, fill that out. Let us know where you're at. And you can also, as it is a link right there for mentoring, you could find that link right there. We found a lot of people have found incredible use for this and have benefited immensely from it, how to utilize these tools and get their trading, to where, I mean, it's just been, I would have to say, an enormous success in the markets, looking at various tools, combining them together, and knowing where to look. I mean, there's no mystery of getting in on the oil before it popped. I mean, that wasn't a stroke of luck. I mean, talking about other names, like looking at the retail apparel sector before it popped. I mean, the stock market's going down, and, here we have specific names moving up. Those are kind of important things. Looking at Marathon Oil, for example, MRO. Granted, it's not going to get you rich quick by buying something at $14.30 and selling it out at $16.88. I mean, but it doesn't hurt in this environment. And that picking up that trade, was something that, these are the kind of things that we've been doing in the trading community. And I know we've got a lot of guys in the room tonight, right now with us, that are part of what we've been doing. So anyway, I want to say thank you very much for your time. I hope the volume level was sufficient, just to give you a kind of an indication of what we're looking at, how these scans really are affecting and helping us select where to be. It's almost like, getting in on the market before, it's in the news. It's always nice to be in a trade and 3 days later see the market up, and then hearing them talk about it on CNBC, because, that might give you that extra push when the retail traders hear the news and they follow in. Remember, for every buyer, there's a seller, and if you want to get out of your trade, what do you got to do? Well, you need someone to buy it so you can sell it to them. So that's always nice. And again, we use tools like the radar screen, my scanner, and the specific indicators we've put together. I'm telling you something, this is very powerful. This has been a very consistent package of trading techniques that has been decades in the works. I mean, this is not something I just created out of thin air. This is what's powerful about this is I've been using this style of analysis for over 35 years, guys. So anyway, if you're looking to learn a little bit more, I welcome you to the suggestions that we've given. Go to that website. I welcome you to the suggestions that we've given. Go to that website or click on that link. Take the survey. That would be great. Again, if you want to know how to get started and you're brand new, then go to the Amazon and buy the green book. I think one of our good friends and community members posted that already for you guys. It's called Mastering the Stock Market. Thanks a lot, Andy, for that post there. All right. Well, that concludes tonight. Good luck with tomorrow's, I don't guess economic numbers. What I try to do is look at overall trends in the market and see the strengths and weaknesses in those sectors and look for opportunities in the stocks. With that said, I don't know a lot of people that are going to initiate a brand new position ahead of a 3-day holiday weekend, but we certainly found a lot of interest in some of the financials with high close doji, a very strong concentration, obviously looking at some of the retail apparel stocks. And again, one of the areas of interest that we will have over the next couple weeks is going to be in the Russell Small Cap because it's less exposure to the global markets, number one, and if the U.S. economy really is turning around, then we should start to spot better opportunities in small caps. Keep in mind, also, to leave you with, keep focus on transportations, the IYT, and also the XOP. Good night, everybody, and I hope you found value in tonight's and this afternoon's session. I thank you for attending.